Major averages all closing in the green today, with the Dow and the S&P posting record closes. Joining us now is Morgan Stanley's chief U.S. equity strategist, Mike Wilson. It's good to see you, albeit a different time of day. Nonetheless, it's always good to talk to you. New record. So how do you feel about stocks right now? What do you tell our viewers to do?
Yeah, I mean, look, we're in this powerful bull market. What we've been trying to do, Scott, as you know, we've been trying to rotate around, try to catch these moves inside the market have been, quite frankly, more important than calling the index. And we've had some success in that. Most recently, we made some more changes in that regard. We think that, basically this recovery is happening at light speed for a lot of different reasons. Policy support, pent-up demand's there. Obviously, the vaccinations are going well. And so what we see in front of us is a cycle that's progressing at about 2 times as fast as it normally does, which means we're going to be moving from the early cycle phase of the recovery to the mid-cycle part of the recovery. And what that means is there are certain things that do better in that kind of economic regime. And one of the key things we think is going to come back into favor is higher quality stocks. They've really underperformed, which is typical in the early cycle, part of the recovery. Now the quality factor is going to start to work again.
Well, I'm kind of surprised looking at the notes. It says that you prefer staples over discretionary. And I thought for a minute when I looked at that, it should be the other way around, shouldn't it?
Well, that's what it's been, right? So we've been the other way since the recession back in April of last year. We basically made the pivot to early cycle, which is discretionary over staples. And as you go into mid-cycle, staples start to do better. What really happens, Scott, is that the discretionary stocks are classic early cycle recovery stocks. Now, everybody's bullish on those because we're going to reopen. But the market knows that. And we've had historical, outperformance in the last 12 months. So it's time to rotate away from those types of securities into areas that have higher quality, and staples fits the bill in that regard.
Yeah, I mean, you're impatient. I mean, we're already moving to mid-cycle. It feels like we just started.
We have in time. That's right. And that's I think that's the trick here, is that this cycle is moving twice as fast as normal. And that's a function of a lot of different things we've written about over time. We're in a different regime now. Monetary policy has taken a backseat to fiscal policy. We have incredible pent-up savings, pent-up demand. And think about this, Scott. We're going to literally turn the economy on like a light switch. Normally, a recovery happens gradually as employees are hired back as business improves. But because of this one-time event of kind of reopening the economy, it's going to happen more quickly. And so that kind of, tells us that it's time to move into the mid-cycle area.
Your staples call is interesting because a lot of people hate staples, which may be very appealing to you. But one reason they hate them right now, Mike, is that interest rates are going up. Yields are rising. And that typically is not attractive for staples, which pay high dividends, which are a low-yield alternative. So do you think that represents a threat?
Yeah, but that threat has been taken out to some degree. So first of all, just to be clear, we are neutral on staples. We went from underweight to neutral. We've been underweight staples because of what you just said. We expected rates to move up. Beginning of the year, we were very out of consensus on where we thought rates would go. But that adjustment has happened now. We think there's more to go. But the market can no longer ignore rates, and they've punished these stocks, right? Interest rate sensitive stocks have been punished, right? High multiple growth stocks have been punished. We think there's some more risk there for the really expensive areas. But generally speaking, the rate shock is no longer a shock anymore. It's a known at this point. Now it's just the pace and the direction and how fast we get there.
Shepard Smith here. Thanks for watching CNBC on YouTube.